should have been liquidated a year prior. Taken advice, instead of closing it down, you just chucked money into it, just come along and overturn that, because it is delaying the inevitable. £80,000 worse because of your inaction to actually liquidate. Effectively, it's game over.
Hello, welcome back to my channel. I am Lucy Johnson, owner of Simplex Accounting, and I am here to speak to Lisa today to hopefully get some details on how to help you if you think that your business is heading towards insolvency. And more importantly, how to fix it. So by the end of this video, I want to be able to provide you with really clear indicators on how you can help your business not be at risk of insolvency and give you really practical solutions to be able to avoid it. So, without further ado, Lisa, please do introduce yourself.
Oh, thanks, Lucy. Thank you for having me on your channel. So I'm Lisa Thomas. I'm a licensed insolvency practitioner at Parker Andrews. I'm based in Plymouth, and I've got over 22 years experience. So I've now got grey hair. I didn't have grey hair when I
Fantastic.
started this. I was about 25 and now I'm nearly 50. So yeah, it's
I
been a
love
long time
how
in the world of insolvency.
I love how positive you are. You know, the industry that you're in is quite like not a very positive sort of topic that we're talking about, but actually it's that yeah, I find that you're very positive, which is really
I
nice to
try
hear.
to be, because you can't, nobody wants to speak to somebody who's all doom and gloom and depressed. I appreciate it's a sensitive and difficult subject, but I wouldn't say it's a necessary evil, but it's something that affects lots of people. And I don't think there's as much stigma surrounding insolvency as perhaps there used to be when I first started. People understand more about it, and lots of people have done it more than once. So
It's good.
yeah,
It's
it's
good that
not
there's not
something.
stigma. You
Yeah,
know,
not
there
something to be
was a
buried
lot,
under the carpet.
yeah, and there was a lot of stigma around money before and a lot more financial things that are gradually, we're gradually breaking through those barriers. So I guess
Yes.
from let's dive straight in. We're talking about sort of red flags that a business may have.
So it might just be useful to your viewers if I just quickly define what the term insolvency means, because
Yeah,
I
please
didn't know
do.
what it meant when I first started for my interview. I had to go home and look it up in the dictionary because I'd never heard it before. But the statutory definition of insolvency is that there's basically you've just got to tick one of three boxes, which is either that you've got an unsatisfied CCJ, a county court judgment, or a statutory demand. You're unable to pay your debts as and when they fall due. Well, that one's easy, isn't it? Well, I mean, most people don't pay their credit card bills on time or what have you. So technically, half the country is probably insolvent on paper. And the other thing is if you've actually got a negative balance sheet. So probably one of your favourite subjects, Lucy, back to the accounts.
What would you say are the top five red flags that are going to indicate that business, they're heading straight one way, and that's insolvency?
Five warning signs. So one is your cash flow. Again, another subject probably close to your heart. If you are finding that you're constantly running out of funds, not able to pay your suppliers because there's not enough cash in the bank, or perhaps hitting an overdraft limit, or considering hitting an overdraft, all those sorts of things are an indicator there's some cash flow issues there. Looking at your creditors and the level of debt. So if you've got big taxes that are looming, that's something you need to have a look at. And actually, that's something you need to look at quite seriously and treat that with priority, because HMRC are actually one of the most likely creditors to take action against the company when it owes its taxes. And they've got the funds to be able to back that up and actually start proceedings, send in the court enforcement officers to potentially take away the company's assets, to force it to cease trading, or force it into what's called a compulsory liquidation, which means game over, unfortunately. If you've got supplier issues, that's another common one. Staff problems. Perhaps you've got quite a high staff turnover, and the reasons for that can be quite varied. It could be that the management is the issue, and you're not able to retain the staff, and then you're having to constantly retrain new staff. That's costing money, or you're losing customers because you haven't got that level of customer care that might be required. You're getting bad press. The staff actually may be able to tell you if you do, the interviews as to why they're leaving. That may give you an indication of what if, is there a common theme over this, and it may be the director themselves is actually the problem, and that's why the staff keep leaving. And just, maybe they're just not a people person, or they're a micromanager, or whatever it is, all sorts of reasons there. But actually, staff problems could be a sign that there's something wrong there with the business model.
Sort of
And
speaks volumes, doesn't it? When you
yeah, I
see
think
staff
so.
turnover, you're getting a different member
Yeah,
of staff talk to you each time you interact with the
yeah.
company. It's not a great look.
Well, it's a knock-on effect as well to the other staff. Imagine if you're constantly having to retrain someone or explain how this works, or don't do that, or whatever it is. Yeah, then you're just going to have everybody's going to be worn out, aren't they? You're going to have
And it is,
burnout.
as you say, it is very costly. That time that you put into training someone, you put
Yeah,
that in, it's like an investment at the beginning of the relationship. If that then ends regularly,
yeah.
it's
And
not great,
mistakes
is it?
happen as well, don't they? So, and it may be that actually not necessarily the staff turnover, but the actual cost and perhaps the structure. So maybe you've just got too much management in the company, depending on the structure. Not enough minions, for want of a better word. um,
Yeah.
or it, that sort of thing could be part of the problem, and it could actually be that redundancy might be the way to go. Perhaps if you are top heavy, or you have got too many staff, or you've made changes to the business model which you think are now going to turn things around, and it's now going to enter back into profit or make more profit, that actually making redundancies long term will be better for the company's cash flow. And of course, that's a very difficult but important decision to make. So, they'll
Yeah, I
need to
was going to
take proper
say,
advice on
if you
that.
if you think you're heading into insolvency, I can imagine that being a really difficult place because not
Yeah,
only not only do you not want to obviously let your staff go, but also you've then got that redundancy pay. I can
yeah,
imagine people come to you with that kind of, but we can't afford the redundancy. How do you
yeah.
sort of navigate
So
that?
with insolvency, actually, if you enter a formal insolvency procedure like liquidation or administration, there's an insolvency, there's a government scheme
Yeah.
known as the Redundancy Payments Office, the RPO, and that steps in and pays the employees most, if not all, of the monies that they're owed in respect of wage arrears, holiday pay arrears, notice pay, some pension contribution shortfalls, and the big one, redundancy. And redundancy actually is usually the biggest expense a company can have if it's looking to make cutbacks or just cease trading. That can usually be a real big debt that the directors haven't necessarily even thought of when they're looking at liabilities. I do sometimes get directors that come to me that look at the figures and say, oh, we're thinking of injecting funds ourselves, ceasing trading, but we think, the deficiency there, we're just going to personally plug that gap ourselves. And in one case I had, they thought the debt was about 25, 30,000. And I said, well, hang on a minute. If you're going to cease trading, there's going to be redundancy costs. They had a lot of employees. You need to go away and look at those figures. And that took the debt to, or the shortfall, sorry, to about 90,000. And then it was no longer viable for them to inject their own funds. So they did end up liquidating. And so although it's a horrible thing, obviously, to have to go through and that decision to make, but if they can't turn things around, they may well find that all of the staff are going to be made redundant because the company's going to have to go into liquidation, be forced to cease trading one way or another. So it may be that is actually the right decision to make. But if they
Yeah.
go through the insolvency route, then that is a little bit of a silver lining there. They don't always understand or know that. They're not always aware of that there is the RPO scheme. So all isn't lost. Because I see a lot of directors put off the decision to take advice and potentially wash the company through an insolvency procedure because they do not want to make a staff redundant. And when I explain that the RPO will kick in, it's quite a weight is lifted off a lot of them because they didn't know about it. So they didn't know that
Yeah.
the government was going to effectively pay the ticket. And fair enough, it's going to take time. And I completely appreciate how distressful it is that staff have to be made redundant. But if it's going to happen anyway, it's better that a director takes control of that and then they understand the timings because it isn't a quick process.
Yeah. And that's why we always come back to actually it's reaching out as soon as possible and sort of getting on
Yeah.
top of it as soon as possible. In terms of that, so we talked about, well, we've talked before about cash flow. How can cash flow issues sort of escalate into this full insolvency crisis?
Well, a number of ways. So I mentioned earlier the CCJs, the County Court judgment, and the statutory demands. So, funny enough, the figure hasn't been changed, I don't think, since I started. But if you're owed only £750 or more, you can issue a statutory demand to a company, which is a formal demand for a debt, and they only have then 21 days to effectively pay that debt off or reach a negotiation settlement with the creditor in order to avoid them taking it to the next stage. If they've got to the stage of issuing a statutory demand, that's usually a sign that they're not going to be willing to negotiate now. They've run out of patience and now this is getting quite serious. And so, therefore, if you're not able to do anything about that debt, it's then potentially can it escalate. They can issue what's called a winding up petition against a limited company, and that will then force the company to cease trading because the bank will pick up on the advert in the London Gazette. The bank will freeze the company accounts, and effectively it's game over. And so, albeit that's not necessarily a commercial decision that all creditors will make, but that's one of the signs that they need to be careful. If you've started to get some big creditors that are owed some bigger debts and they start getting scratchy, those are the ones that you need to keep an eye on and look after. Sorry, I don't think I answered your question.
No, no, that's really helpful because it's around I was talking around sort of cash flow issues and
Oh,
how it can
yes,
become
yes.
that big
Sorry, yes.
crisis.
And so that's one of the things. If it gets to the stage where you can't pay your suppliers, those are the sort of actions they're going to take. They're going to go off and get county court judgment. They might send in the CEO, the court enforcement officers, which we used to know as bailiffs. They're potentially going to get sent in. Then they can take away goods and assets to the value of the debt, plus interest, plus costs. Now it's all starting to escalate. Everything's getting more serious, and taking away the company assets could very well force it to cease trading. So again, these cash flow issues are the biggest thing that you really want to keep an eye on with help from accountants like yourself is to have a look at the cash flow and look at the months perhaps where maybe everything's going to fall at once. Your VAT quarter is due. Suddenly you've got this big VAT debt and you realize you're not going to be able to pay it. Perhaps you're a seasonal business and you need to get to the summer, but actually you're not going to be able to reach the summer because you're going to have all this debt that's built up in the meantime. And you need to maybe consider, can we inject funds? Can we do something else to build up an income, a different income stream, or maximize our income stream to keep us going in those months where we can see the cash flow forecast shows us there's going to be some months where we're hitting our overdraft limits, for example.
Yeah, and I think with you and I, Lisa, we've spoken before about, people not burying their head in the sand and, they might have known about this was going to happen, say, 3 weeks ago. But
Yeah,
actually with cash flow, you should have known about it months before it happened. And
yeah,
actually, it's getting as far ahead as possible. A VAT bill should not be a surprise. All of these things are not a
yeah.
surprise to us.
Well, the
And
corporation
actually,
tax as well, because
yeah,
they have a good year. Great, you made a profit last year.
they forget
Um,
about that bit,
but
don't
you
they?
forget you're going to have to pay the tax then, and you haven't necessarily, they haven't set that aside. I'm sure you recommend your clients to have maybe different pots for putting tax monies and bits and pieces aside. So when those bills come in, you're already prepared and you've got the funds ready to pay it.
Yeah, exactly. Like people will either have just a tax pot, or I even take it to the extreme. I have a pot for every single type of tax. I even have a pot for my staff, every single thing, so that we
Yeah,
can build it up and say, well, whatever happens, this is how my cash flow is going. I can pay my staff for X amount of months. I can pay my VAT and I've got my corporation tax. And, it's all just being prepared and ahead. And
Exactly.
as you say, if you actually look on a cash flow forecast, you can see months and months in advance of, oh, in 7 months' time, actually, we're going to have a bit of a problem here.
Yeah.
What can I do now to save that? What are we going to do something in marketing? Are we going to push this out? Are we going to
Yeah.
upsell? Are we going to increase our price? Whatever it is,
Yeah.
it's just being in control of that cash flow makes a huge difference to where you're going to end up, I guess.
Yeah, and I think a lot of directors, understandably, they don't necessarily, they're not perhaps very good with their figures, which is exactly where you guys come in. But they perhaps don't have cash flow forecasts. And so one of my, and I'm sure it's yours as well, our biggest bugbear is with accounts, because lots of directors that I see have relied too heavily on the annual accounts, and those can potentially not be produced until 9 months after the year end, so they are way out of date. And in the perfect world, I'll always recommend, if you can, produce management accounts and get yourself to help them with that. And then if they've got, and they don't have to be monthly, they don't have to be weekly, daily, but perhaps just quarterly. At least then you're a little bit ahead of the game, and you know
Yeah,
where you stand. It's not as simple as saying, "Oh, I've got 30 grand in the bank account, so we're solvent." Well, yeah, but you've got 200 grand's worth of liability. So actually, you're 170,000 pounds efficiency if you want to look at it like that. And so the insolvency practitioner in me, gets a bit excited then. But um, so it's yes, it potentially there's a cost that comes with that, but I think sometimes that's a cost you can't afford not to pay. Because in order to understand how to produce a cash flow forecast, and they don't necessarily need to be that complicated and that detailed down to every penny, but just a broad brush, and perhaps some of the higher level stuff which you can no doubt help them with, and then they can have an idea exactly as you said earlier. Oh, look at this, we're going to have a problem in September,
yeah.
and
And the high
that's
level
why you can
overview
prepare
is
for it.
Yeah, and high level overview is way better than no overview,
Nothing. Yeah,
you know?
exactly.
So
Yeah,
actually, if getting in the weeds of everything is a lot, you can just condense it. And I split out my sales line by line. I have about 40 different sales line items, but it does depend. You don't have to look at things that granularly. You can
yeah,
sort of, yeah. So going back to sort of like HMRC debt. Obviously, HMRC debt can become a really big issue.
yes.
What point does it become like a legal problem?
The issue with HMRC is there's no, that I'm aware of, they don't have a specific policy of at what stage do they effectively transfer that customer to their debt management team. And so you can have clients that have been bimbling along with a huge debt for ages and they've taken zero action, and it's just carrying on and the debt's slowly getting bigger and bigger over time. And then you've got other customers perhaps, or companies, sorry, where they've actually built up a debt to HMRC and they find that they start getting scratchy very quickly. And so the warning signs are, I had one recently where they phoned me up because a winding up petition had been received by HMRC, but that didn't happen overnight, because before they will get to that stage, HMRC are going to issue at least one warning letter. They're going to send a notice, that we're fed up now. You've got this debt is overdue, and we're going to start taking action shortly. And then the next part of that procedure, at the very least, will be they're going to issue what's called the statutory demand that I referred to,
Yeah,
which gives them 3 weeks. Then they're going to send a legal letter saying, right, we're issuing a winding up petition, here it is. And usually there's about, I think it's 2 weeks before the winding up hearing, or it might be 7 days, that has to be advertised in the Gazette. But usually that's issued, I think, that, depending on the court hearing timings, about 6 to 8 weeks beforehand. So none of these things happened overnight. You've had warnings of this probably for, I would say, at least 3 months.
yeah,
And so those are the worst types of letters to ignore, because HMRC have got the funding and the wherewithal to actually issue those statutory demands and those winding up petitions because they need to stop the debt from getting any bigger and they want to force the company to cease trading. So they are going to go as far as to liquidate a company if it's a material debt. Whereas your smaller creditors won't necessarily be able to afford the legal fees and the costs that come along with taking those sorts of action. And so if they've got a relatively small debt, it may even say £5,000, it's not going to make commercial sense to them to throw another £5,000 on top of that, forcing that company into liquidation, especially as they're probably what's classed as an unsecured creditor, which means they're unlikely then to get a dividend back. They may get their petition costs back, but they're not actually going to get any of the capital debt paid back. So is that really going to be worthwhile? Possibly not. So it really depends on the level of debt that's owed and the type of creditor you're going after. I've seen some creditors that are very aggressive and have quite an aggressive policy when it
Yeah.
comes to debt collectors, and others are a lot more lenient.
So when it comes to sort of how we deal with more of the supplier issues, whether that's if there's like credit being cut, they say actually our terms are no longer like this, whether they are demanding sort of upfront payments.
Yeah.
How do you see like what signals the trouble here?
Yeah, it can be a real mixture of all sorts of things, exactly as you've said, those types of things, which to be fair to the directors are out of their hand. If their supplier suddenly turns around, says we're cutting our payment terms, maybe it's time you look around and change suppliers. It may actually be the right thing for the company. They may have been with the same supplier for years. Of course, everybody's finding their pockets are being hit for all sorts of different reasons. And we've got some more hits on the horizon with the increases to the taxes that are coming up, which I'm sure you're having to field off lots of queries from your customers about that. So yeah, so lots of things can be warning signs. So it could be they've got this creditor pressure, they've perhaps had a threat, a legal letter, they're getting constantly bombarded by creditors that they want to get payments for. Perhaps the accounts have just been done and the accountant said you've got a problem here, you've made a loss. Or perhaps they've gone to draw a dividend and you've said actually you can't because there's not enough reserves, and then there's a red flag with that. A red flag, which you and I have spoken about before, because our favourite subject is with the director loan accounts,
Yeah.
where I see them often being overdrawn, and sometimes the actual reason for the company's insolvency is the directors have treated the company like a bank. And I also see the other side of that, where they've unfortunately thrown money in, time after time, to the extent where they've lost pensions or houses because they haven't taken advice early enough, and yeah, they find themselves facing insolvency, which is frustrating.
So in terms of going back to sort of staff and things like that, what are the risks of continuing to pay your staff when the business can't afford it?
Yeah, so you're effectively then potentially delaying insolvency because you can't afford to pay anybody else and you put all your money into looking after the employees, which
Yeah.
I think is probably giving everybody a bit of false hope because
Yeah.
the staff are still being paid. And I can give you a perfect example of this actually. I dealt with a company a few years ago and had to go and make the staff redundant, which was obviously not very nice. There's about 20 of them. And understandably, they were all completely shocked and upset. They had absolutely no indication that this was going to happen.
Yeah.
And then when we had the creditors meeting, at which a director had to be present and answer any questions, the employees were really angry because they didn't quite understand a document called the Statement of Affairs, which we present at the meeting. It's effectively a balance sheet. So it shows the company's assets less its liabilities equals the shortfall we expect to be at the end of the liquidation. And this particular director was the largest creditor because he was owed 200 grand. And they were like, why is he the largest creditor? He's owed £200,000. And I was like, yeah, that's the amount of debt he's owed because he's put this money in order to keep paying your wages for an extra year. So the company should have been liquidated a year prior, in my opinion. It had been
Wow.
insolvent for a while. And
Wow.
instead of taking advice, instead of closing it down, then he just chucked money into it. And it was really gut-wrenching because the employees actually were going to get all of their money back through the RPO scheme that I mentioned earlier. But the
Yeah.
director was likely going to have to lose his house because he'd given the bank a personal guarantee for the loan that he'd used to pay to keep the company going. And then once the staff understood that they were going to get their redundancy, the mood completely changed. They were happy, oh, I'm going to get thousands of pounds and never like this job anyway. And, this is giving me the push that I wanted and all those sorts of things.
Yeah.
But so, yes, so I think it can give everybody false hope, but
Yeah.
it's no good paying the staff if you can't pay the other creditors. You're just kicking the can down the
Delaying
road.
it. Yeah.
Exactly. And the other issue is directors have to be a little bit careful in what creditors they pay
Yeah.
because when a company enters a formal insolvency procedure like liquidation or administration, the liquidator's got a duty to investigate what's caused the company's demise, whether or not the directors have committed any misconduct, inadvertently or not. And if they have, we've got the power to lift the corporate veil and then pursue the directors personally. One of the biggest claims that we tend to bring about against directors is something called illegal preferences. And this is where your company's insolvent and you've got some money, but not enough to pay everybody off. And rather than liquidate and give that money over to the liquidator to pay out the creditors in a specific priority in accordance with the law,
Yeah.
start using the money to pay the people that they want to pay. And so actually, some of the monies that they pay to the employees, so I've seen it happen in the past where they've paid them their redundancy. And so redundancy is classed as what's called an unsecured creditor. There are other creditors that come ahead of the unsecured creditors. You've got your preferential creditors and your secured creditors, for example.
Yeah.
And so we can say, well, you preferred those creditors over these other creditors. You didn't pay HMRC back their money, but you paid back the staff's and redundancy. You didn't pay perhaps even some of the staff for their wages and their preferential claim, but you paid your mum back because she
Yeah.
she loaned the company 10 grand, or the bigger one is director's loan account. You paid yourself back your director's loan account, or you paid back creditors that you've given personal guarantees to, because you can see, the company's going to go into liquidation. You don't want to have to pay all these debts, so you're going to use the company's money to pay back these creditors. And so, not going off on a bit of a tangent about what you asked about paying the staff, but using the company assets to pay certain liabilities doesn't necessarily help because it is delaying the inevitable. And then it may mean that actually you've spent the company's money and assets and now you can't afford insolvency. And then now the staff aren't going to get paid their redundancy or their monies because they're not going to be able to make a claim against the redundancy payments office.
I'm assuming that has quite a negative impact on the director themselves as well. Like for yourself, would you have to sort of tell them that that person has actually acted sort of unprofessionally or
Yeah, so from the director's point of view, if they've committed misconduct, so for me personally, I prefer to talk to the directors about this before. In the
yeah,
initial meeting, I'll explain to them, look, it's such a weird relationship, Lucy, because we're like gamekeepers turned poachers sometimes because directors
yeah,
instruct us to help hold their hand and put their company into liquidation, and we do all of that. But then
yeah,
once we're appointed, I've got a different hat on now, and my duty is to the general body of creditors. So now I've got to do that investigation into the director's conduct. And
yeah.
so if I find there has been misconduct and I end up having to sue them, you can imagine that relationship very quickly turns sour because they've committed misconduct. And the one way to prevent those sorts of claims from happening is to take that advice early and to understand the sort of claims that an IP could bring against you so that you avoid making those sorts of transactions and you're a bit more aware of the sorts of things that can come back to bite you personally.
Yeah. And I guess, yeah, that would make it would scare people, but actually, if you get there first, you can warn people of this is how to
Yeah,
do it, and this is how to
exactly.
avoid those problems.
Exactly. It stops them from having a conflict because What I often get is directors come to me. They've got a director's loan account which is overdrawn, which is all the accountant's fault. It's your fault. You never explained to them what it was, and they didn't ask you. They just willy-nilly signed the accounts, oblivious. And so then they come to me and we have a chat about that director's loan account. And I explain, depending on their personal financial situation, the liquidator's job is to call that in and collect it. So they're going to have to repay some or all of it back. And so, as you can imagine, that doesn't go down very well. And then they will, even though they've got a duty to mitigate the position, and if their company's insolvent, they should potentially be liquidating it, depending on the circumstances. They don't want to because they know they've got a direct loan account that they don't want to pay back.
Yeah.
And had they not had that conflict, if that wasn't an issue, they would probably, yeah, great, no problem, I'll liquidate it. But those are the ones where, they're very reluctant and, because they've got this issue now, they've put themselves in a conflicting corner with the money that they owe back to the company. And sometimes it's actually the whole reason why the company needs to go bust because they've taken too much out.
Yeah. No, I can imagine. It's one of those things as well with director's loan. As soon as somebody comes to me, it's immediately telling them, do you know you have a director's loan? Your previous accountant might not have told you,
Of
but
course they
this is what it
didn't.
means. This is what all of these things actually mean, and this
Yeah.
is what we want to do to try and get rid of it. But yeah, and the amount of people that just say, "Oh yeah, I've got a director's loan of this," and I think, do you know what that actually means? Do you know the implications, the tax implications?
Exactly. And then the other thing is, I probably bored you earlier with the fact that the accounts are usually 9 months out of date, as you know. And when I say bored you earlier, I mean for your viewers, because you know that. So directors will come to me and we'll have a bit of a chat, and I'll say, oh, what's your director's loan account position? Oh, I don't know, or it's fine. And I'm like, well, looking at the filed accounts on Companies House, it looks like you had an overdrawn balance of whatever figure. Oh yeah, yeah, yeah. But I think, and I'm like, well, you need to check because we're now a year on. And so that position is your accounts are out of date, you haven't filed them, we're having this chat. What I don't want them to do is say, yep, I'm going to liquidate. We do our investigation and we discover their director's loan account that they thought was 10 grand is now 80.
Yeah.
And that happens to me frequently where they think it's a lot less than it is. And I always say to them, go back to your accountant or go back through the bank statements or what have you, establish what your DLA is first before you push the go button so we can have
Yeah.
a conversation about it before we liquidate and you know where you stand and we can have a chat about how much you're going to need to repay.
100%. It's one of those things. It's fine if you know what's going on, if you know how much it is, we've got it all under control, we've got a process in place. But if you haven't, it can be really, really dangerous.
Yeah,
Just going back to, so how do you think financial stress impacts business owners? Obviously, from my side of things, I think it can lead to all sorts of different sort of bad decisions, really, because
yeah,
when you get stressed, you do inevitably make a lot of bad decisions. I'm assuming you've seen quite a few of those.
yeah.
How do you think
It's
that?
it's knee jerk, isn't it? Exactly, because the financial stress is then going to cause emotional and physical stress to these directors. They are potentially making bad decisions. They are making decisions which could come back to bite them personally, exactly as I said to you earlier. So they think, oh God, my company's going to go under in a minute. I'm going to take these assets and I'm going to transfer them into my own name. Or for example, bankruptcy. I know we're not talking about that today, but a common question I get asked when people know that they're going to go bankrupt is they think they'll just transfer their property out of their name into their wife's name or their friend or their spouse or what have you. I'm like, no, the trustee in bankruptcy will just come along and overturn that. It's an
They'll
illegal
see right through it.
transaction. Yeah, exactly. It's an illegal transaction. And it's the same with insolvency of limited companies. The same thing. We're going to do an investigation into your conduct. And therefore, if you're making these knee-jerk, stressful decisions because you're under all this pressure and you're like, a supplier rings you up and they're really aggressive and you get scared. So you send them whatever's left in the bank account. That's not done you any favors now because you've still got all these other angry creditors over here with their pitchforks and it hasn't got you anywhere in respect of actually solving the solution.
Yeah. No, 100%. So, I know you and I have spoken about this before, Lisa, but what can business owners do to turn things around? You know, they've spotted those early warning signs. What can they actually do?
So, key advice number one, speak to their accountant. So ideally produce management accounts, which we've touched upon before, regular management accounts. You can't afford not to produce them, and produce cash flow forecasts. Let's have a little look going forward. Where are your issues going to be? And start drilling down onto these figures, because we need to understand what is causing the company's insolvency. Because if you don't understand that, you're not going to be able to trade out of this potential insolvency. I get a lot of directors come to me and they want to do the Phoenix that I think I mentioned before when we've chatted previously, where you look to liquidate your company and start again, the same or similar business. And how that works practically, the short version is the directors will buy the assets off the old company in their new company and hopefully sail off into the sunset, doing the same thing again. They've left behind all the debt that's going to get killed off. But there's no point doing a Phoenix if you haven't figured out what's caused this company to go bust in the first place, or if you're just not being realistic about it, because you're just going to end up in the same position again and you may be worse off the second time around. And so I think it's always getting to the crux of the insolvency is the issue and trying to get out of that. So it's looking at things like management accounts, flash flow, cash flow forecasts, but monitoring them. There's no point producing a cash flow forecast and then not bothering to check how you're doing and compare against it and measuring things and
Yeah.
making changes when you start to veer off that path. Because you just bury your head in the sand and hope things are going to magically solve themselves. And unfortunately, they're not.
No, 100%. As well, it's when things change from the plan. So even if you're doing it month by month, when things change, why did they change? And is that going to happen in the future? I think
Yeah,
some people think that they can just plan the next 12 months, and actually, when changes happen, it just happens. Oh,
yeah.
something else has cropped up. And actually, we don't adjust things. So that's
Exactly. You have to move
really,
with
really
the
important.
times. You can't just stick in the
100%.
same old thing, doing, the same old thing, hoping for a different outcome. That's not going to help. And burying your head in the sand, absolutely. I know it's really easy for me to say don't do it, but don't do it, because you need to be proactive. Because just sitting there hoping things are going to magically fix themselves, it isn't going to work. And I once had somebody call me up. I'd never spoken to them before, didn't know who they were, from Adam, and they literally, their first phone call to me was because a bailiff had just turned up at their premises and they wanted my help. And I was like, well, I'll have a chat, but there's nothing I can do because it's just too late
Too
now.
late.
After they've cleared your premises, give me a call and we'll talk about insolvency. But those are the sorts of things where, and that's an extreme, of course, but when you don't take advice early, those are the sorts of things that can happen.
That's awful. And I know you just spoke about sort of a phoenix and things, but how effective is restructuring? Like, what does that process actually involve? And is it viable? Do people actually do that?
So your different insolvency types are: liquidation is where you're going to cease to trade and call it a day, and that's the end of it. You've got administration, where we will look to trade the business for a certain length of time in order to finish off some profitable contracts, or buy enough time to market the business on a going concern basis and get it sold. And that's hopefully then a rescue. And so each of those are on a case by case basis. And the thing is, with administration, you ring fence out the creditors, so administration protects the company from being liquidated by a creditor. So it gives the administrators time to form a strategy and work out a proposal. And then you've got something else called a CVA, which is a company voluntary arrangement. And this is where the debt is frozen. The company puts proposals to its creditors to continue trading for a period of up to 5 years. And in order to do that, they need to have identified what's caused the company's insolvency, that they fixed that issue, that they can produce at least 12 months worth of profitable forecasts, cash flow forecasts, which are realistic. and then put those proposals to creditors, and assuming 75% of them in value and vote in favour, and they are proposed, they are accepted, then the CVA is put in place. But if they haven't been realistic with those cash flow forecasts, or they haven't really fixed the problems that cause the insolvency, and for whatever reason, then they find themselves not being able to make the contributions from those profits into the CVA pot, they're going to find themselves back at square one again. They're going to breach the terms of the CVA, and they're going to be back to facing liquidation. And so rescue can happen in a number of ways. Through an insolvency procedure, it's going to be through a CVA or an administration, or it could be, as I mentioned, they may liquidate and do a phoenix, or via the administration, the existing management team or directors might actually be that buyer that I mentioned that's going to buy the company or the business, sorry, back off the administrator. So there are lots of ways to do that. And also, depending on how insolvent the company is and what sort of how quickly they can get on top of things, they might be able to avoid doing it through a formal insolvency procedure, because it's not cheap. It's not cheap to put your company in administration and pay an insolvency practitioner and their team to be working on your business in there, marketing this business and looking to get it sold in order to pay a dividend back to the creditors. And so ideally, if you can avoid that and rescue it without the need of insolvency procedure, fantastic. But then you're probably going to want the skills of a turnaround expert that might help you, if it's not something your accountant can offer as part of their package to you. I don't know if that's something you offer, dealing with turnaround, Lucy, or management. Do you deal with management accounts and cash flow
We do,
forecasts?
yeah, we do a lot with management accounts and cash flow forecasts. I
Yeah,
highly recommend them because of obviously all of these reasons.
yes.
But yeah, I would always recommend people are looking at their figures and yeah. So what should directors do if creditors are threatening legal action? What's like the first few steps?
Okay, please don't, first of all, don't ignore it, because that is not going to do you any favors. And so I would say you need to take advice. Now, it depends on the sort of legal action they're taking. If it is a creditor and it is a debt that you accept that you do owe, you just can't afford it, then, this is an issue with repayment and potential insolvency. And so, sorry to harp on, but speak to an insolvency practitioner. If it's perhaps some sort of contingent liability and there's maybe a dispute and now there's creditors threatening to sue, you've had a legal letter, that really is looking to take some legal advice on the position. Perhaps you are legally able to dispute the debt and bat it off. Don't, so many directors are here ignore things like that, and then the creditor goes and gets a county court judgment, and then before you know it, now the knock-on effect that we spoke about earlier with the statutory demand and the winding up petition, they just sometimes they're not even aware that they've had a CCJ against them because it's been sent to the company's registered office. Perhaps they haven't paid their accountant's bill. The accountant's registered office is the address. So for whatever reason, the post hasn't been forwarded to them. And so they haven't found out about it until it's too late. You've just got to be on top of all these sorts of things. So
Yeah.
yeah, if you get a
You hear
scratchy
about
letter from a,
CCJs going to the wrong address. It's
yeah,
terrifying.
yeah,
Yeah,
that's our old address. We moved out of there a year ago. Well, did you not put a redirection on? And
yeah.
yeah,
So it's all the little bits, but it's so important, isn't it?
exactly. Yeah. So
So
take advice, or always back to take some professional advice, depending on what it is you've received.
yeah, and I guess is there that human element of like letting people know? Like, do you have that whole, well, actually we're struggling, but I guess it's coming up with payment terms and trying to negotiate and trying to have that
Yeah.
conversation early rather than just leaving it and ignoring it.
Yeah, sometimes, because sometimes directors come to me and they're like, oh, what should we tell everyone? What should we tell our staff? What should we tell our suppliers? And that's difficult to answer, because until you've made your decision of what you're going to do, there's not really any point telling all. Yes, you can tell your suppliers, we're struggling, if that's a good strategy to use with that supplier to try to negotiate some sort of repayment plan, tug on their heartstrings a little bit. But there's no point going back to people to say, oh, well, we're taking advice from an insolvency practitioner. because that could trigger that creditor then, if they've got a CCJ, to send in court enforcement officers because they want to recover assets quickly
Yeah.
before you knock things over. And so what you decide to tell them, I always say to my directors, they come to me for advice, and I always say, go away and sleep on it, do your research, get a second opinion, what have you, come back to me if you want to. But there's no point now going back to all the staff, today and suppliers to say we've spoken to an insolvency practitioner, because you've not actually made a decision of what you're going to do based on the back of that advice yet.
Yeah,
So
I guess it's
yeah,
like a lot of things in business. You've got to make that decision and then you need to go
yeah.
with it.
And
I,
because
I
it's the same,
guess
especially with staff. Sorry to interrupt you,
no.
but one thing when it comes to telling the staff, they say, what do we tell our staff? Again, if you haven't made your decision yet, I would steer clear of telling them anything, because what you don't want is staff to down tools, because that's going to force you to cease trading
Yeah,
immediately. And also the other thing is, people directors often want to keep things confidential, depending on the strategy we discussed with the liquidation, perhaps protecting the assets and getting them removed to stop the landlords distraining on them, things like that. There may be some strategy that we need to have a little think about. And the moment you tell the staff, every man and his dog has found out about it, because understandably they go home panicked, upset, worried about redundancy, and word starts spreading like wildfire. And even if they had every intention of keeping this just between them and themselves, them and the staff, yeah, the suppliers and creditors soon find out about it quickly.
yeah. It's making those difficult decisions and just yeah. When it comes to negotiating payment terms with suppliers and all of your creditors to prevent the insolvency, is it actually going to help prevent it or is it delaying the inevitable?
And I think that really depends on the specific circumstances, because it is, every case is different. So
Yeah,
sometimes I'll get people coming to me because they've spoken to their mate down the pub, who's in a CVA, and they want to do the same thing. And then when I go through it with them, I say, well, it's not really viable to you. You've only got, let's say, two creditors. Or actually, a CVA isn't going to work because HMRC are preferential, and looking at your figures, even if you were able to carry on trading, they're going to take all of the money. Your other creditors aren't going to get paid.
yeah,
Um, so it depends on the number of creditors, and back to the cash flow forecast, what can you afford to pay them? Don't overpromise. And your negotiating skills, if,
yeah.
if if you're going to get aggressive back on the phone to a creditor, that's not going to do you any favors.
No, no, I
And
can
so, yeah,
imagine.
again, it's just having a look, having a chat to your accountant, looking at the accounts, looking at cash flow forecasts, try and go back again to identify what's caused the company's insolvency. And it could be that it's a number of different factors and they're out of your hands, or it could be that it's one specific event that's happened. Perhaps you've laid all your eggs in one basket and you've only got one customer and they've just withdrawn their contract with you, for example. Or you've
Yeah,
had a massive customer debtor and they've just gone bust themselves and you're not going to get paid that money now. So you need time to make some adjustments. It is, every case is different. So it's back to taking advice from your accountant, maybe speaking to an IP, working out what options have we got, what is viable, and finding out. If I think this isn't, great, you've taken early advice, but actually I think you can maybe just negotiate with a couple of your creditors, maybe reach a time to pay plan with HMRC or TTP. They are clamping down and now insisting you've got to pay your debt back over 12 months, but that may buy enough time that they need to get over those hurdles and trade out of insolvency.
yeah, they definitely are clamping down. And from my side of things, I see it where they're actually clamping down on ridiculous amounts. There can be,
Really?
yeah, I've seen all sorts of things for sort of pennies before, like really.
Wow.
So that have gone to sort of debt management. So, and I think it also depends potentially where they're getting, maybe where they're sort of putting all their efforts. So whether that's VAT or self-assessment, I think it sometimes depends on what tax it is as well.
Yeah.
But
It
yeah,
depends on what day
definitely.
of the week it is, I think,
Yeah,
Lucy, with HMRC,
yeah.
if I'm honest.
What legal protections are available for the directors who are acting responsibly? What legal protections are there, if they're still struggling with the business?
it's really hard because even if their company's insolvent and they're carrying on trading, you're not going to be able to get a legal protection to stop a potential subsequent liquidator suing you for misfeasance. There are some insurances out there. I think you can get director protection insurance, but I think that if a claim against a director is for misfeasance, the insurance won't pay out. So you have to have a little look at those terms. So yeah, really hard when it comes to, if you mean protection to stop them being sued, the
Yeah,
protection is don't commit the misconduct. And for them to know what they're doing, they need to take advice on what that misconduct is and get an understanding of that.
yeah, I guess there's protection in general because, you know, a lot of people will start a limited company and say, right, I'm a completely separate legal entity, it's
Oh
all
yeah.
there. And actually, they don't realize the things that can come back to
They
them.
haven't got a clue, Lucy. This is another of my bugbears. It is, in my opinion, far too easy to set up to set up a limited company, and B, to become a director of one with absolutely no skills, qualifications, or experience, rack up potentially
Very
hundreds of
quickly.
thousands of debt very
Yeah.
quickly, and then liquidate and walk away. And so, you know, they need to be aware of what they're doing, and it all harps back to getting professional advice, speaking to an accountant before you set up a limited company to make sure it is the correct entity and it is the right way, and so get a general understanding of just the basics in accountancy and tax and law and your director's duties. I'm pretty sure there's tons of courses and things out there you can go and do, so you've got a
Yeah.
basic understanding, because it's not good enough, unfortunately, for some. If you liquidate and the liquidator pursues you and says you've committed this illegal preference on this date and you now owe the company £50,000 back, there's no defense to that for them to say, oh, I didn't know it was an illegal preference because I didn't understand the Insolvency Act.
Would you say that having a limited company actually isn't a legal protection in itself?
Well, it is, because they do have that benefit of the corporate veil. And actually, if they haven't done anything wrong, um, then they're not now liable for all of those companies' debts. But what I do see is directors, I spoke to someone recently, it was a sad one, because I can't remember what the figures were, 50, 80,000 or something. And they wanted to liquidate the company, but they'd given personal guarantees to almost every single creditor. Had that not happened, they could have walked away debt free and left that company, liquidated it, and killed off the debt and walked away. But liquidation was not going to solve their issues, because now all they're doing is those personal guarantees were then going to be called in. They're going to be personally insolvent. So yes, you do have that benefit of the corporate veil, and as long as you're not bankrupted or disqualified or committed misconduct, then it shouldn't be an issue. The issue is when they enter insolvency territory, they then inadvertently start committing those offences unknowingly, which is understandable, but all the reason to do your research and take advice as soon as you can.
Yeah. I think you've answered some of my questions actually. So I was going to ask, what is wrongful trading and how can directors avoid personal liability?
Okay, so wrongful trading is where a director knows or ought to have known that they have passed the point of return and that there is no prospect of the company avoiding insolvent liquidation. And somehow, and for whatever reason, they continue trading. And in that period, the position gets worse. And so when an insolvency practitioner does their investigation, they say, well, actually, say 6 months ago, you were insolvent and the deficiency was £20,000 and the company had some assets. But now, 6 months on, the company's sold all of its assets and now there's 100 grand of liability. And so we can say that the position has got £80,000 worse because of your inaction to actually liquidate the company. So you have traded wrongfully. Now, having said that, it's quite difficult to prove wrongful trading and quite expensive to bring about. And what often happens is, if you've got a claim of wrongful trading, it usually means that there have been other types of misconduct in that period, which are easier to pursue directors for, like the illegal preferences that I've mentioned, or a transaction at an undervalue where you sell an asset for less than its market value or transfer it for free, for example, or just general misfeasance where you haven't protected customer deposits or you have taken unlawful dividends. So all those sorts of things tend to happen. The illegal preferences is the most common one, where you prefer one creditor above another. So when we're looking at insolvency, generally wrongful trading is hard and difficult to bring about, really complicated and really expensive, but there's usually something else, because it isn't just normally one thing. If you've been trading wrongfully for a length of time, you've been committing other offences in that period.
So if a business is insolvent but is still trading,
Mm.
when does that actually become illegal?
Yeah, so well, they've effectively, as soon as the company, it's difficult. You almost need to draw a timeline out to see,
Yeah,
when is the point of no return and
yeah,
what have the directors done to mitigate the position. So what I'll always say to directors who are thinking of trying to continue to trade and trade out of it is back to what we talked about previously. Get your self-management accounts, monitor them carefully, keep an eye on all the figures, produce cash flow forecasts and monitor where you are on those. And every time you make a financial decision, you need to be keeping proper board minutes of these decisions. And as soon as you can see something's happened and it hasn't worked, where things are getting better and they start to get worse, that's really where you probably need to be taking advice. I mean, ideally, they should be taking advice when they can see they're heading for insolvency, but
yeah.
there'll come a time when you're at the stage of no return, and at this date, you should have known. It was obvious you were going to be liquidated. Maybe they'd had a statutory demand from a creditor, or HMRC had issued them with a winding up petition or that threat, and they just
Yeah.
carried on trading anyway.
Yeah. And so what are the key protections directors should have in place? So whether that's documentation, we've spoken obviously about seeking professional advice as soon as possible,
Yeah.
things like that. What are those key protections that we can advise directors to have in place?
Yeah, so ideally you are going to want an accountant on board. You are going to want a solicitor on board. I know they come with a cost, but sometimes you can't afford not to pay them. You're going to want to make sure you have proper board meetings. And this sounds daft, even if you're a one-man band and you've just made a decision, you need to have a written note of that, and it needs to be minuted so that if, unfortunately, in due course, your company is liquidated and you are being investigated, one of the questions is, why did you make this decision and what was it based on? You can go back and prove it. Oh, here are my minutes. This is what I did, and this was a reasonable decision to make in the specific circumstances at that time. And here's all the evidence. Here's all the information I had at that time I made that decision. So that's another way of protecting yourself, is to keep a record of all your decision making going forward.
That's so important. And it's something that I've only really realized. We obviously harp on about the legalities of having things, legal documents and minutes and things like that for
Yes.
accounts and stuff like that. But in terms of actually those decisions that you've made in the business, especially when you're a one-man band, because when you are a sole director, it's
Yeah.
one of those things you don't actually have the board meeting.
Nobody writes a
Um,
file note out to themselves.
no,
Today I was sat at my desk at this time and I made this decision because Joe Bloggs had messaged me and he promised me this big order. And,
yeah.
it doesn't work like that, does it? But, if you were, say, working for a larger company, which did have a big board of directors, that's what you'd be doing. You'd be looking at all the financial information available to you. You'd all be making a group decision and that would all be minuted and documented. And I think sole directors do tend to forget that, and then it's only retrospectively then when they're being questioned further down the line they've got to come up with the evidence. How did you make this decision at the time? And coming up with that evidence, sometimes they haven't got enough to support their defense.
No, it's like what I say in accountancy. We don't want to be going back 6 months ago and trying to
uh,
work out what happened. We just, or even further if you're further behind. But We
Yeah.
want to know, the time, what happened. It's so much easier just to make a few notes, leave it aside.
Just email
So
yourself.
fine, yeah, yeah.
Email yourself a little note.
Yeah, that's such a good point. And also, things like this, we have all sorts of things with AI nowadays that can compress and make like little notes. So
Yeah.
there's no excuse. Final question before I leave you. How can business owners, how can you help business owners or they help themselves before it's too late?
So I think in terms of helping themselves, they can do some research. So there's so much information out there now. There's so much different resources out there. I've got my own YouTube channel, Lisa Thomas, the Liquidator. If you don't want to speak to me, you can have a look at those videos. Hopefully, I've covered most subjects on there, albeit I'm still growing the channel. They can pick up the phone to me. My initial meeting is always free and it's confidential, and they're not under any obligation to advise me or instruct me, even if I can help. So I always think it doesn't cost anything but time. You can have a chat to me anonymously if you want. I'll give you the advice, and then what they do with that is up to them. So I think it's just a case of doing a little bit of research. What I really love is when directors come to me and they've already done their research and they do have a little bit of an understanding of the things that I'm going to be talking about, so that it's not as overwhelming and me bombarding them with all this information, which I'm very mindful of. But it's difficult when you're speaking to a company with lots of options, because then I'm having to explain all these different insolvency procedures, the different ramifications of each one. And then if they want to know about the investigation, the different types of misconduct, there's 6 different types of misconduct. It's so much information for them to take in.
Yeah,
I do have one of my videos on my YouTube goes through the 5 or 6 different insolvency procedures, in a summary, not too much detail. It's about 20 minutes long, but I'll email that to directors if I can before we chat, to say you might want to watch this video before we speak, so
yeah,
that now they're starting to get a little bit of an idea. Oh, actually, I think CVA isn't going to work for me, and I think we are going to end up going down the liquidation route. They can get an understanding of what to expect, I guess.
yeah. No, that's really helpful. Thank you so much, Lisa, for joining me today.
Oh, you're welcome.
It's been brilliant. We've really had to we've really been able to dive deep and hopefully help people see those signs that before they head towards insolvency and actually be
Yeah.
able to actionably sort of fix things. Um, yeah, I will make sure all of your links are in the thing below, so please do have a look in the description below. And yeah, thank you so much for joining me, Lisa.
Oh, thanks for having me, Lucy. Lovely to see you.